Hi everybody, and welcome back to our first video in Chapter 21. Here we're going to be looking at accounting changes and error analysis. After studying this chapter, you should be able to 1. Discuss the types of accounting changes and the accounting for changes in accounting principles. 2. Describe the accounting changes in estimates and changes in the reporting entity. 3. Describe the accounting for correction of errors. And 4. Analyze the effect of errors. As we preview Chapter 22, here we're going to take a look at accounting changes. 1. Background. 2. Changes in accounting principle. 3. Other accounting change issues. And then under other changes, 1. We'll have changes in accounting estimates, and 2. Changes in reporting entity. For accounting errors, we have 1. Adjustments and restatements, and 2. A summary. And for error analysis, we'll take a look at reclassification of errors, balance sheet and income statement errors, a comprehensive example, and preparation of statements with error corrections. All right, let's get into the meat of the chapter. First, we're going to discuss the types of accounting changes and the accounting for changes in accounting principles. Here, under accounting alternatives, 1. Diminish the comparability of financial information and obscure useful historical trend data. The types of accounting changes are 1. Change in accounting principle, 2. Change in accounting estimates, and 3. Change in reporting entity. Errors are not considered an accounting change. Okay. So if we illustrate this a little bit, a change in accounting principle is a change from one generally accepted accounting principle to another one. For example, 1. Changing from LIFO to average, weighted average cost for inventory cost allocation, and 2. Adoption of new generally accepted accounting standards. A change in accounting estimates is a change that occurs as the result of new information or additional experience. For example, 1. A change in the estimate of the useful lives of depreciable assets, and 2. Updating estimates on accrued warranty expenditures. And as we look at change in reporting entity, a change from one reporting as one type entity to another type entity. For example, 1. Changing from individual to consolidated reporting. And number 2, changing the subsidiaries for which a company prepares consolidated financial statements. All right, let's take a look at the 3 types of changes. The FASB classifies changes into 3 types because each type involves different methods of recognizing changes when a company presents comparative financial statements. 1. Report the changes retrospectively. Number 2. Report the changes currently. And 3. Report the changes prospectively. A change in accounting principle involves a change from one generally accepted accounting principle to another. So when a company has a change in accounting principle, the FASB requires that companies use the retrospective approach. And the rationale is that users can then better compare results from one period to the next. So if we look at retrospective accounting change approach, when applying retrospective approach, a company follows three basic steps. One, adjust the carrying amounts of affected assets and liabilities as of the beginning of the current year. Two, recast the financial statements for each prior period presented. And three, prepare a disclosure detailing the change. Okay, let's look at an illustration here for the Lancer Company. A change in accounting principle was made by the Lancer Company. They have accounted for its inventory using the LIFO method. In 2025, the company changes to the FIFO method. The following is additional information. One, Lancer Company started its operations on January 1, 2023. At that time, stockholders invested $100,000 in the business in exchange for common stock. Number two, all sales, purchases, and operating expenses for the period in 2023 and 2025 are cash transactions. Lancer's cash flows over this period are as follows, and they detail that by sales, purchases, operating expenses, and cash flow from operations for 2023, 2024, and 2025. Number three, Lancer has used the LIFO method for financial reporting since its inception. Number four, inventory determined under LIFO and FIFO for the period 2023 through 2025 is as follows. And they give that breakdown from January 1, 2023 all the way to the end of 2025 using the LIFO method and the FIFO method and showing the differences. Number five, the cost of goods sold under LIFO and FIFO for the period 2023 through 2025 are as follows, and here are those years, LIFO amounts, FIFO amounts, and the different amounts. And number six, earnings per share information is not required on the income statement. And number seven, all tax effects for this illustration should be ignored. Okay, let's take a look. So if we look at a financial statement for LIFO, here is the illustration. We have sales, less the cost of goods sold, less the operating expenses, gives us net income for 2023, 2024, and 2025. Now, retained earnings are going to be beginning retained earnings plus this net income will give us retained earnings for the end of 2023, 2024, and 2025. Now, if we show the statement of cash flows and the company's balance sheet as of December 31, here is our cash, our inventory at LIFO, total assets, common stock, retained earnings, and total liabilities for the 3 years. And then for the statement of cash flows, we have the cash flows from operating activities here. We have the cash flows from financing activities here. And the cash flows from, looks like, investing activities here. And so the net increase in cash at the beginning of the year, and then the calculation of cash at the end of the year. Okay. Now, if we look at the income statement for FIFO, we do the same thing. We have our income statement here with sales, cost of goods sold at FIFO, and operating expenses and net income for the 3 years. And then our retained earnings are shown with the beginning retained earnings of 0. We add our net income. We get ending retained earnings for the 3 years. So again, we're showing this balance sheet and statement of cash flows. Here's our balance sheet for inventory. So that does affect our retained earnings from the standpoint of the income statement that we just went through. And then our statement of cash flows remains pretty much unchanged from what we're showing here under LIFO. Okay, so the adjusting entry for the current year then. In comparing the information on those prior illustrations, Lancer analyzes its net income as follows. Here's the 2023 net income under LIFO, less than FIFO. So FIFO is showing more income in 23 and 2024. And the total at the beginning of 2025 then is $220,000 for LIFO, $225,000 for FIFO, and a difference of $5,000. So the total in 2025 is going to be $87,000 for FIFO, $89,000, and finally the difference of $2,000. So the question is, what entry should Lancer make to record the change to the FIFO method? Okay, to record the change to the FIFO method at the beginning of 2025, we're going to debit inventory for $5,000 and credit retained earnings for $5,000. Let's go back and we can see that $5,000 is here. The change increases the inventory account by $5,000. This amount represents the difference between ending inventory at December 31, 2024 under LIFO, $20,000, and ending inventory under FIFO, $25,000. So the credit to retained earnings indicates the amount needed to change the prior year's income, assuming that Lancer had used FIFO in previous periods. So when we report a change in principal, when a company presents comparative statements, all years presented are shown using the new accounting principle. That means that prior years must be updated to report amounts under the new principle. Okay, so disclosures related to accounting changes. Here, the nature of and reason for the change in accounting principle. This must include an explanation of why the newly adopted accounting principle is preferable. And then the method of applying the change, and 1, a description of the prior period information that has been retrospectively adjusted, if any. Number 2, the effect of the change on income from continuing operations, net income, or other appropriate captions of changes in net assets or performance indicators, and any other affected line items, and any affected per share amounts for the current period, and for any prior periods retrospectively adjusted. And then 3, the cumulative effect of the change on retained earnings or other components of equity or net assets in the balance sheet as of the beginning of the earliest period presented. That looks like a good place to stop this video. And when we return, we'll take a look at completing the illustration. Until that time, bye for now.